everyone, and welcome to another WP TV special. My name is James Burton, Managing Editor of Wealth Professional Canada. For this episode, I'm delighted to welcome Rob Lauzon, Chief Investment Officer at Middlefield. Rob, welcome.
Yeah, nice to be here.
Now, Middlefield is 40 plus years old, I believe, is an independent active manager and specializes in equity income strategies. So what better opportunity to pick your brains, Rob, on what makes the firm tick? First up, Rob, how has dividend investing stood up to the test of the past 12 months?
Well, it's definitely been a test, and it's done the job, and I guess it's true colors of Sean, like dividend income strategies. One benchmark we look at is the S&P 500 Aristocrat Index, which is full of dividend payers and growers, and that was down 6% last year on a total return basis. That being said, the S&P 500 was down 18% approximately, so it's 12% outperformance. And in fact, Middlefield's flagship dividend fund, our Income Plus class, which I run, was flat on the year. So I outperformed the S&P 500 with that fund by 18% because of a lot of things that we may talk about today, is just dividend income, lower volatility, and some of those attributes.
Yeah, thanks, Rob. Now, in your 20 years at Middlefield, what have you learned about how the strategy performs?
The main two things, it is kind of an all-weather strategy. It performs quite well in down years like we saw last year, and the great financial crisis was another time period when dividend strategies outperform, but it also performs well in up years. And it might not be the top performing style of investing when the market's rocking and rolling, but it provides great total returns in positive years. So it's an all-weather strategy. But what's important, there's two main things when you're looking at dividend investing. One is dividends over time, and we've looked at a 30-year study, provide about 45% of the total return that you expect from the stock market comes from compounding your dividends. And just over half, 55% or so, comes from capital appreciation. So it's very important in the long run to get a part of your total return in the form of dividends and compounding those dividends. Another key point with dividend investing is there's a dividend sweet spot, and we call those dividend growers. And if you look back on that same 30-year strategy, which, you know, the time period we chose ended at the end of last year, dividend growers, dividend aristocrats, outperformed the S&P 500 by about 50%. So if you would have put $100 in each strategy 30 years ago, you'd have 50% more money over that time period. So they both made you a lot of money over those 30 years if we go back, but three decades. But dividend compounding, it works. And, you know, it works for growth investors, because you can drip and you can compound your returns that way if you don't want to pull the income out. But most importantly, for income investors, it creates an income stream through the dividends.
So just building on that, Rob, obviously preserving capital is the name of the game as well. How does your strategy help do that for high net worth clients?
Yeah, when looking at high net worth clients specifically, they've already built a nest egg up. They want to protect it. And the way I look at it, it's like a golf analogy. You're starting the year, if you're a dividend investors, at the forward tees, because you're already, if your portfolio gives you a 4% dividend yield, you know, the market can be down 4% and you're flat and you've protected capital. You haven't lost money. So that's very important. Number two, dividend income in Canada here is more tax efficient than interest income. So on an after-tax basis, that's very important as well. You know, you're ahead of the game there as well. And so definitely bonds can preserve capital, but you know, equity investing, dividend equity investing has shown to outperform bond investing over the long run, but essentially on an after-tax basis, it's even more powerful. I guess the third would just be dividend stocks. If that high net worth investor wanted exposure to the equity market, dividend stocks have lower drawdowns, less volatile environments. So they insulate it from that standpoint as well, just lower day-to-day volatility. So when you're looking to pull out capital, maybe at the wrong time when we're in a bear market and everything's down 20%, your fund might only be down 6%, like perhaps the dividend index last year. So less of your capital has been drawn down right at the time you're looking to, you know, buy another house in Miami or something if you're a high net worth individual.
Thanks, Rob. Now, as you well know, a lot has been written about the 12 months ahead, from market volatility to the likelihood of recession. From your perspective, what do you see as the biggest challenges and the biggest opportunities for the next 12 months?
Yeah, the biggest challenge is, we don't know how bad margin compression and earnings will be this year. We know the world is slowing. We know GDP growth is slowing. We know rates went up a lot last year and inflation went up a lot last year, but we also know that's coming down now. And the rate increases we're at the end of that. Whether it's 2 more by the Fed, 1 more by the Bank of Canada, we're at the later innings of that. So those are all known, but what we don't know is how that will impact the consumer and business this year, because there's a lag effect. So rates went up, as mortgages roll over, as corporate debt rolls over in 23 and 24, there's going to be some tightening there. Margins could come down. If earnings come down in a big way, if we get into a recession, those are the unknowns. We could have some more choppy markets. And then there's always the geopolitical risk. You've got Iran-Israel issues. You've got China, US, Taiwan tensions. We're in a war right now. So all of that can change on a dime, which no one can predict. You can just kind of insulate yourself as much as you can from those type of exogenous events with just proper portfolio management. So those are, what we're cautious about. And we're running our portfolios generally fully invested, but cautious and defensively, and dividends help. What am I optimistic about? Well, the rapid rise in rates is coming to an end sometime in the first half of 23. That gives us a pretty good outlook for 24. So we're 12 to 18 months from a really rosy outlook where year over year comps look better. There's a few subsectors that 2 out of the 3 had a rough year last year. REITs, which give you high levels of income. I think if you can buy real estate companies in Canada, where we've got lots of immigration, our economy from that standpoint should be fairly strong, and those immigrants need to stay in apartments. So the apartment sector is a sector that was down a lot last year. We like that this year. Clean technology, there's a lot of things happening. The Inflation Reduction Act in the United States, more of that happening in Europe. There's gonna be a lot of infrastructure, onshoring spend in that space. So solar, battery storage, there's some interesting opportunities in there with companies that, in some of them, some of the multinational industrials pay dividends. And then we do like resources. That's a kind of a theme, many of which are increasing their dividends. There's been an underinvestment in mining, energy over the last 5 to 10 years. And as the economy gets better, late 23, 24, China reopens, there's going to be a draw on a smaller supply of commodities, and we think that's going to give a pretty good tailwind to those sectors. So I'm optimistic on those sectors. We're cautiously optimistic in starting out here in 23.
Fantastic, Rob. Thanks so much for joining us. And that wraps up another WP TV special. Rob, thanks so much for joining us today and sharing your insight.
Yeah, thanks for being.
Now you can find out more about Rob, Middlefield, and the team there at middlefield.com. And don't forget to go to wealthprofessional.ca for all the latest news and views on the industry. I'm James Burton. Until next time.